steps. Step number 1, let's go over all of the bailouts. And there are hundreds, thousands, millions of them, it seems like. Whenever you turn on the news or you look at YouTube or Twitter, it's nothing but another bailout. So let's try to get our heads around everything that's going on right now so we can understand how the Fed is screwing us royally. It starts with the Fed on the left. Of course, all these arrows are pointing in their direction. The ABC, that's the primary dealers and the banks under the Fed's umbrella. XYZ are the corporations. We got HF, hedge funds, financial institutions, and money market funds. Below them is the corporate bond market, the commercial paper market, the stock market, and the repo market. Then, of course, we have the real economy on the left. It's always kind of off in the distance, kind of the bastard stepchild of the Fed. And we've got the retail banks between the Fed and the real economy. Okay, now that we understand that, let's go to the programs themselves. According to the Fed's website, it starts with CPFF, Commercial Paper Funding Facility. All this is short-term loans to corporations so they can pay their expenses, they can meet payroll, that just the short-term liquidity needs get satisfied. It's commercial paper, corporate paper market. They're basically propping the market up so when these corporations have to roll over the short-term debt, they don't have to pay a very high interest rate. Next is the PDCF. This is the primary dealer credit facility. What's really important to notice here is that the Fed is allowing the primary dealers to give them all types of collateral. It's not just like the repo market where they're taking mortgage-backed securities and treasuries. Here they're taking everything, including equities. So this is when they started. March 17th is when I came on, and in my videos I started saying, listen guys, they're already buying stocks. And all the talking heads are like, no, they can't buy stocks, it's illegal. They can't buy junk bonds, it's illegal. More on that later. And I said, no, it's just easy. All they're doing is telling the primary dealers to go out there and buy stocks, buy junk bonds, buy corporate debt, put them on your balance sheet. We'll just give you a loan that's 90 days, or really you can just keep rolling over forever at no interest, which is basically like giving you money, and we'll take those assets, put them onto our balance sheet. So it's just an indirect way, in my opinion, for the Fed to buy stocks, and no one calls them out on this. It's crazy. Moving on to our favorite four-letter solution alphabet soup program, and that is none other than MILF. The Money Market Mutual Fund Liquidity Facility. This is simply the Fed propping up the money market funds. So all the people come in, they want redemptions, they want their money back because they're freaked out with what's going on with the cerveza sickness and the recession/depression. So instead of all of these funds having to liquidate their assets to meet the redemptions or pay back the people that have invested with them, all they have to do is borrow money from the Fed. This goes right back to the Fed propping up the corporations, because what do the money market funds have that they would sell to meet their redemptions? Well, of course, commercial paper. It's the exact same commercial paper that the Fed is propping up in the CPFF. So the Fed doesn't want to go in there, prop up the market by buying when all the money market funds are selling. So to avoid that, the Fed says, listen, we'll just bail out everyone. We'll give free money to everyone, not just the corporations, but the money market funds that could potentially be selling any of the debt the corporations have. Takes us to number 4, the PMCCF, Primary Market Corporate Credit Facility. This is the Fed going in and just basically buying corporate debt. It's plain and simple. They might have to set up some sort of special purpose vehicle just to get around the law. But there is no law when it comes to the Fed. Everyone always brings up the Federal Reserve Act. Listen, they're not paying any attention to that whatsoever. And any type of again, quote unquote law they have to get around, they'll just set up some wink and nod program so they don't have to pay any attention to it. There is no line in the sand. The Fed is going to do whatever they need to do to prop up the entire system and bail out everybody except the average Joe and Jane. I've been saying it all the way back in March when all the talking heads were saying, okay, what's the line in the sand? What is the Fed not going to do? It's simple. They're going to do everything. And sure enough, as we go through this date line, you see that they just keep adding more and more and more programs. They're never going to stop with this nonsense. Moving on. SMCCF, that's the Secondary Market Corporate Credit Facility. This is basically where the Fed buys existing corporate debt. So the primary market is where they buy the original debt. The secondary market corporate credit facility is where they buy existing corporate debt, again, to keep those interest rates low. Moving on, TALF or ALF, whichever you prefer. Term Asset-Backed Securities Loan Facility. This is the first program that's set up to try to assist Main Street from the standpoint of their giving investors, and I still haven't figured out who these investors are, most likely the big banks. They're giving them money to continually buy just normal things in the real economy, such as student loans, credit card debt, subprime auto loans, to make sure that credit is still being issued to these types of borrowers. Next is the MSNLF, which is Main Street New Loan Facility, and this is combined with the Main Street Expanded Loan Facility, and this is for small and mid-sized business. But I want to point out that they don't go directly to the Fed. They have to go to their local bank, call it Wells Fargo, Bank of America, and try to get these loans. This is a bridge loan to get them through the cerveza sickness, or it can be in the form of PPPLF, which is the Paycheck Protection Program Lending Facility. Really pretty much the same thing. It's giving money to small and mid-sized businesses to help them stay afloat. But I do see a lot of moral hazard here. I love the fact that they're doing stuff for Main Street, but if you're a restaurant, let's say, and you were going out of business before, why wouldn't you go try to get as much loan money as possible and then just shut your doors? There's a lot of things that could go wrong here. They don't have to have financials, and I get it. They're trying to get money to Main Street as quickly as possible. That's great, but like everything else, there's unintended consequences for sure. We skipped over one program here. Let's go back to that. The Municipal Liquidity Facility. This isn't on my list because for whatever reason, they don't have some snappy acronym or abbreviation for this. I think they left this out because they don't want the average Joe and Jane to realize they're also bailing out states and local governments. If you go back through my videos, I have been saying this the whole time. They're not only going to bail out Wall Street, they're going to bail out all their cronies, all the politicians at the state and local level as well. That's pretty much what this is. The last thing we have on our list is FEMA. If you haven't seen my video on FEMA, make sure you check that out. It's basically another repo market outside of the United States, specifically for central banks. And that money flows down to foreign corporations that have dollar-denominated debt. So what happens? The central bank can give the Fed treasuries as collateral, and the Fed gives them the dollars they need to operate. This serves two purposes. Number one, it keeps the dollar from exploding higher, which would just crush a lot of the world economy. But it also allows the Fed to take these treasuries and put them onto their balance sheet, again, preventing the entities from selling the treasuries. Why would they want to do this? Because it keeps the interest rates artificially low. And there's one thing I forgot to mention. Let's go back to the PMCCF or the SMCCF. This is where the Fed is buying corporate bonds. The Fed isn't doing it through the desk. at the New York Fed like they typically do with their open market operations. They've hired a private corporation to do this. Who do you think it is? Of course, BlackRock CEO Larry Fink. So the Fed says, here's all these billions and trillions of dollars. BlackRock, go in and buy the corporate bonds you think should be purchased. Well, what's BlackRock going to do? Of course, they're going to buy the bond funds or the bonds that are in the funds they own. If you didn't know it, BlackRock has several bond funds. Editor, go ahead and just do a quick Google search. And when we scroll down, you'll see they've got at least 4, 5, 6 bond funds. I think if you go to their website, they've probably got even more than that. So think about the conflict of interest. They have billions, if not trillions of dollars at their disposal, and the Fed is telling them to buy whatever corporate bonds they think they should buy. Well, of course, they're going to prop up the corporate debt they own so they don't have to take a haircut. This is crony capitalism at its finest. For any of you watching this video that think capitalism is to blame for any of this, you've got to understand we haven't had capitalism in the United States for decades. What we've been seeing has nothing to do with capitalism, and it has everything to do with the Fed bailing out their bankster crony buddies like Larry Fink and Jamie Dimon. That is the bottom line. Now that we understand what these programs are all about, let's understand the logistics and how they kind of operate here. So I know these arrows are extremely confusing. Let's walk through those. For the CPFF, this is a direct bailout going down to XYZ, which are the corporations. The PDCF is a bailout for the primary dealers and banks under the Fed's umbrella. There's a lot more to it, but we'll get into that in just a moment. Then MILF is a bailout for the money market funds, but like we said earlier, indirectly another bailout for the corporations. PMCCF and SMCCF, if you follow these arrows, they go directly to the corporations. TALF, MSNLF, MSELF, and the PPLF are the bailouts that are intended for small businesses and mid-sized businesses. If we follow those arrows, they go right around to the, we'll call it the bastard stepchild. I think the Fed wishes they could solely focus on corporations and the financial economy. And when they have to deal with the real economy, it's kind of like, man, do we really have to do that again? That stupid real economy. Why do we have to deal with that? That's why I call it the bastard stepchild. But we see these programs are intended to prop up small businesses and mid-sized businesses. But I want to point out that all of the bastard stepchildren have to go through the retail banking system. Then the retail banking system goes to the Fed. So there's an additional layer of bureaucracy where the corporations, the primary dealer banks, the hedge funds, the financial institutions, they just go directly to the Fed. Very efficient. They get their problem solved immediately. Then there's the municipal liquidity facility. That is not on the list, but also, of course, going directly to the Fed. And then FEMA goes to the central banks, and then the liquidity goes down to the foreign corporations from those central banks. The Fed has also set up FX swap lines or dollar swap lines. For more on that, let's go to my full-length interview with the man himself from Wall Street for Main Street, Jason Burek.
Okay, so most foreign exchange reserves or sovereign wealth funds are used for investments normally, but foreign exchange reserves are normally used to protect the exchange rate of the currency, to protect the currency. Like what happened in the Asian tiger crisis. So the Asian tiger crisis, you had, I'll just give a very quick summary. You had all these Asian countries that had dollar pegs. And so they had run up too much debt, and the currency traders were temporarily, they had offered higher interest rates for foreign investors, foreign direct investors to come in, but this was hot money that could leave. So the debt problems in these Asian countries started to balloon, and then the hot money, so net capital outflows, started leaving. So then the government finances became in peril, and the currency exchange rate started to really wobble, and the Fed at that point had to step in. That's when the currency swaps, the central bank level currency swaps started, but they were much, much smaller back then. They started, I think initially, James Turk has talked about this in his latest book with John Rubino, that the original currency swaps were for like 8 billion, 10 billion from the Asian tiger crisis in Mexico. So at that point, when foreign banks blew up and the Wall Street banks or hedge funds had leveraged currency trades or foreign government bond trades that went bad, the Fed has always been willing to step in and do these currency swap lines.
But I'd also like to point out that look at how many of the arrows are pointed directly at the corporations. Right here, we've got 1, 2, 3, and indirectly, probably 2 or 3 more. So what is this telling us? It's telling us that the Fed is most concerned about big corporations. And I'd like to point out that the Fed is also now buying ETFs of corporate bonds. How many bailouts do the big corporations need? This is insane. It's almost like the corporations are making more money now than they ever did before the cerveza sickness, because they're just getting all this free money that the Fed is showering on them that's directly being paid by the taxpayer, either now or in the future. And let's not forget about repo infinity and QE infinity. So when we look at the markets themselves, the primary dealers, because of these bailouts and all this extra liquidity the Fed is giving to them, they're able to prop up the corporate bond market, the commercial paper market, the stock market, and the repo market. And the money market funds, financial institutions, and hedge funds are able to prop up the exact same markets, basically all of them. And the Fed is buying ETFs to additionally prop up corporate bonds. How much propping up do the corporate bonds need? They're getting ETFs, they're getting PMCCFs, they're getting SMCCFs, and they're getting the backdoor bailout with MILF. It becomes obvious why the Fed does all these programs with this alphabet soup type smoke and mirrors to make it as confusing as possible for the average Joe and Jane. Because if the normal person out there on the street knew exactly what the Fed was doing, they would be pissed. Rightfully so. They'd go to the street with pitchforks. And the Fed just wants to make it seem like this is just business as usual. Nothing to see here. Just move along. Step number 2. To understand exactly how the Fed is screwing you over, we have to recognize the importance of prices in the everyday economy. As an example, on my left, let's use communism or central planning. On my right, we'll go with a free market capitalist society. So if prices go down in the capitalist society, this tells the marketplace as a whole there's a surplus. If prices go up, this is telling us that there's low supply of XYZ commodity, good, or service. In this case, we're using lumber. These are my fantastic fir trees that I've drawn up in the Pacific Northwest, and right below it is the lumber mill. So if prices go down, this tells the consumer they can consume more of the product, and it tells the producer they should produce less. The opposite happens when the price goes up. So in this case, let's say the price of lumber goes down to $10. Well, the consumer is going to say, whoa, I can buy all the lumber I want. And the producers are going to say, okay, time out. We need to produce a lot less. But of course, the opposite is true. If lumber goes up to $100 per board, we'll call it, per 2x4. I don't know, just the cost of lumber. I don't know what quantity, but it just goes up to $100. Then the consumers say, whoa, time out. We need to consume less lumber. And the producers say, whoa, we've got to produce more lumber. Let's cut down some trees. Also, the allocation of scarce resources. So the mill is cutting down some trees, which we don't have an unlimited supply of. In the marketplace, there's different prices depending on the geographic location. This is the beauty of the bottoms up approach. Well, the excess demand that's increasing prices in the middle of the country, let's say Dallas, is a result of more jobs being created. There's more jobs being created because they can produce goods and services more efficiently in that location. If there's more jobs, there's more population, most likely more demand for housing. That increases the price of lumber. See how well this works? Let's say on the West Coast, lumber is a little cheaper, and in the Northeast, lumber is super cheap. So this tells the mill they need to send more lumber to Dallas than they're sending to the West Coast, and they need to send more lumber to the West Coast than they're sending to the Northeast. All the scarce resources that we have get allocated in the most efficient way possible. Contrast this to the central planned economy where there are no prices whatsoever. So if there's no prices, nobody knows what to do. They don't know how many trees to cut down. The only thing they're doing is just making guesses from mathematical calculations that could be right or wrong coming down from the government. Well, they could cut down way too many trees. They could cut down too few trees, and they wouldn't know where those trees were being used most efficiently in the entire country, because no one knows if lumber there is $1, is it $100, where does it go, how much should we consume, how much should we produce. It's all a mystery. That's why it leads to so much inefficiency, waste. You've got two programs. One is bottoms up, where it's the individual making the decision on what they need and want on a daily basis for themselves and their family, compared to just a bunch of bureaucrats sitting in big office buildings in the capital city making or trying to make decisions on what they think is right, not just for the entire country, but probably more so for themselves. And of course, there's nobody better at explaining this than one of my absolute favorite economists of all time, probably my favorite, Thomas Sowell, talking about the allocation of scarce resources with alternative uses. This was a virtually impossible task for the central planners to perform well, though it presented no special problem in a market economy where millions of consumers and producers each keep track and influence a relative handful of prices which directly affect them. The net result was it was common in the Soviet Union to have warehouses bulging with unwanted and unsold goods, while people were lined up in queues for other things they wanted and hoped to get before supplies ran out. In a capitalist economy, the prices of surplus goods piled up in warehouses would have fallen because supply and demand, forcing the enterprises which produce them to cut back in order to avoid counting losses. This in turn would release resources, including labor, that would be in demand in other sectors of the economy where shortages and rising prices would have produced higher profits and thus greater demand for labor and raw materials needed to increase the supply of the more profitable output. But no such process took place in socialist economies where simultaneous shortages and surpluses could persist for years until overburdened central planners could get around to dealing with each problem. Step number 3, the Fed distorts all prices. This is where we start to connect the dots. We know that price discovery and prices give us all the information and the data we need to allocate scarce resources with alternative uses, such as your time and your money. So you may be asking yourself, George, how on earth does the Fed distort all prices? Well, very easy, just like a planned economy or just like communism. Let me explain. Money is one half of every single transaction. Every time we purchase a good or service, the other side of the transaction is money or currency. But interest rates are the price of money. And if the price of money is artificially low, that means the Fed is manipulating every single price in the entire economy. The exact same thing that central planners did in communism. That's why it failed, because there were no prices and the marketplace, the economy, couldn't get the signals they need to make sure they're allocating those scarce resources efficiently. Let's go ahead and use a specific example so you can see how this plays out in everyday life. The Fed comes in with all of their programs we discussed in step number 1. This increases stock prices and it increases prices in the junk bond market and all markets in general. I'm just using these two to illustrate the point. And remember that when prices go up in a bond market, interest rates go down. That means companies like Uber can sell their equity or their stock at a higher price, and they can borrow money in the bond market at a lower price. This begs the question, would Uber even exist if the Fed hadn't kept interest rates at zero for so long? Not to mention QE, the repo market bailout, and now what they're doing with all of these funding facilities, programs, alphabet soup of every type of solution you can think of for the Fed just to literally print money and throw it at these corporations that otherwise would go out of business. But getting back to Uber, let's see how this plays out with real life individuals and entities. So the owner of Uber stock sees his portfolio go up, so he spends more money and he saves less money. Remember, this is a result of the Fed manipulating prices and bailing out corporations. The next guy owns Uber debt, or he's thinking about buying Uber debt, So he goes into the market and says, wow, Uber debt is only yielding about maybe 3 or 4%. Investment grade debt is yielding 2%. So Uber must not be that risky because the price is telling me that they're a good, safe bet. So he goes in or she goes in and buys Uber debt, not knowing that they're taking far more risk than they know about. The next guy comes in and he's an Uber driver. So he says, look at this. I can work for Uber as a side hustle. I can make all this money. So I'm going to go out and buy a brand new Prius just for my Uber job because I think the business itself is sustainable long term. Why wouldn't it be? They've been in business a long, long time. They're a publicly traded company and they're not going bust during a pandemic. And this hall of mirrors the Fed creates goes down even to the consumer level. Let's say you're someone that decides to buy a house in town and you don't want to get a car. You want to live that lifestyle because you know that the Uber service is permanent. You can just take an Uber to work, an Uber to restaurant, an Uber to the movie theater, no problem. You build your entire lifestyle and potentially a lot of your big purchase decisions on Uber being there long term. But let's not forget about the lumber yard. In San Francisco, let's say where Uber is located, I'm guessing it's in San Francisco or Palo Alto, someplace around there, but let's just say that it's San Francisco. all these jobs are flooding into that town, all these high-paying jobs. Of course they can pay people $100,000, $200,000 a year. That's the magic of not having to make a profit, because the Fed is propping up your stock prices and your access to debt. Aha! Funny how that works, isn't it? So all these people flood into San Francisco. Well, there needs to be homes built. Even if there's a lack of supply in San Francisco, they've got to build homes out in Marin County. They've got to go across the bridge. They've got to go into the East Bay. They need to build all of this housing because all the people are flooding in because of the fake jobs that really might not be sustainable. They might only be there because of the Fed manipulating prices through the bailouts. So all the lumber goes down into the Bay Area because they're paying $1,000 for the lumber. And then the Dallas guy and the guy up in the Northeast, they get shut out. They don't get as much lumber as they otherwise would have. Also, with the mill, they cut down a lot more trees than they otherwise would have because they need to supply San Francisco with as much lumber as they can possibly get out of the forest. I'm telling you, not to go off on a tangent, but if you're an environmentalist or kind of like a greenie person, you should hate what the Fed is doing, because there's millions of trees that are being chopped down over the last 10 years to build housing that we really didn't need if the Fed would have allowed the housing market to crash and clear properly, even with low supply. The fact is, there's not enough people that could afford homes if the Fed wouldn't have propped up the bubble economy. But that's a tangent. More on that in another video. So you can see what's happening is it's distorting the decision-making process of all the people involved and the entities involved. It's misallocating resources to a massive degree. So the Fed creates an economy that's extremely inefficient, and as a result, you get screwed. It goes right back to the Fed, 0% interest rates, and the bailouts. And if your friend and family member Fred is calling you a tinfoil hatter for being pissed off about what's going on right now, tell them you're in really good company. Let's go to one of the most powerful pieces of content I have ever heard in my life on the last episode of Macro Voices.
I wonder at what cost. I'm appalled at the moral hazard that these companies that were just months ago doing lavish share buybacks to enrich company ownership are now first in line for the largest bailout in the history of the world. Not to mention that the very first firms that got bailed out were these mega hedge funds that were doing levered risk parity trades and levered basis trades that were bailed out via the repo market so they could delever those trades without completely capsizing their firms. So, people talk about bailing out the pizza restaurant down the street or the small business owner. They're getting the table scraps. The guys who are first, who are dining at the buffet, are the mega hedge funds. They're getting huge liquidity handouts from the Fed so that they don't have to post losses on their levered basis trades and their levered risk parity trades. And then right after that are these big corporations that just previously were feasting on leveraged share buybacks and are now being supported directly by the Federal Reserve. That impact is shocking to me. And I'm not going to say shocking. I think it's just quite sad. And it makes me sad. It makes me sad because you almost feel like capitalism died.
For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.